Here's why buying a vehicle at the end of the year is not always the best case for your tax bill. Um, so what do I mean by that? You see this all the time on TikTok where people are writing off their Lamborghinis and G wagons because it's over 6,000 pounds, and they it's $0 down. They financed a $150,000 G wagon. They get to bonus depreciate $150,000 because it meets the qualifications of it being over 6,000 pounds. Awesome, great. I'm gonna tell you why that's dumb. So why that's silly is number one, there's two different types of bonus depreciation that these guys are referring to. First of all, it's section 179, and then what's commonly referred to as bonus depreciation at section 168K. So let's explain the two differences. Section 179 is there there is a limitation on how much you can depreciate. So let's say your business income for the taxable business income for the year is $100,000, and you go out and you buy the G wagon for 150, and you think, yes, I've created the $50,000 loss. No, that's not how it works. You can only depreciate it up until the 100,000 until you have $0 of taxable income. That's where it breaks, right? You cannot manufacture a tax loss using Section 179 that goes past $0. You cannot create a tax loss for your business. A la, it's not going to flow through to your personal return as negative $50,000 or a tax loss or a tax deduction that goes against all of your other forms of income, right? Uh, Now let's get into bonus depreciation, Section 168K. So it looks like so let's rewind for a second. So TCJA changed bonus depreciation. They're allowed to deduct 100%. That eventually phases out. So in 2023, you could only deduct up to 80%. So if you bought a vehicle for, let's say, $100, I know that's crazy. The maximum 168K or bonus depreciation method, it would be $80. So you wouldn't be able to deduct it all the way. Now, the difference between 168K and 179, why it's built up this such a big buzzword, whenever it was at 100%, so that means you could take an asset that you purchased for your business, let's say it's $100, you could, whenever it's at 100%, you could do 100% depreciation. So you write it all off. The famous phrase, it's a write-off, right? Okay, so that's great. That's awesome. The key difference between 168K or bonus depreciation and 179, bonus depreciation or section 168K can create a tax loss. That's really the main. I mean, obviously there are other differences, such as like different eligible properties, the flexibility to apply different, 179 and 168K to different asset classes. But that's not really the purpose of this video. And number one, you don't care. You're going to call your tax guy and say, hey, this is going on. What should I do? But here's why it's stupid to make a decision for tax purposes is no one ever talks about if you finance that vehicle for 150,000 and let's say interest rates, especially during 2022, 23, where on auto loans we're at that 5 to 7 to maybe 9 depending on your credit, maybe even 11%, especially new businesses if they're registering the business name. It's a high interest rate, right? So you're going to pay off that balance of the loan longer. It's a lot more cash flow, number one, and a lot more of it's getting allocated to interest. So what happens is these people will go out and they'll buy their $100,000 vehicle and say, oh, this is a tax write-off because I saw it on TikTok. I'm writing it all off. I'm creating a tax loss. Number one, that's not happening anymore. And number two, whenever you go to sell that vehicle, right, there's two options ways this works out. I guess three. Number one, the vehicle breaks down in the business and basically you get it scrapped. And, hopefully it's under warranty, but let's say it's not under warranty. So the vehicle is, like, I don't know, I'm not a mechanic, but let's say the whole engine blows up spontaneously. I have no idea why that would happen. Like I said, I'm not a mechanic. But let's say that happens. Cars, it's scrapped. But you still owe $140,000 on that vehicle. And so you're going to still owe the $140,000. That sucks. You're not going to create a taxable gain event because you didn't get any value for that vehicle that broke down and got scrapped, right? Insurance doesn't cover. Let's just pretend that insurance doesn't cover. Most of the time it doesn't cover the vehicle. Um, you know, the vehicle's engine spontaneously combusting. We're using wild examples. I know. Just stick with me. That's option one. You're gonna have $140,000 to pay off, and now you need a new vehicle for the business. That sucks, but no taxable gain. Scenario two, you pay the vehicle down, blah blah blah, and you thinking, okay, well I've hit, let's say I've hit 55,000 miles. I'm fixing to go over my warranty, and you decide I don't want to buy another warranty. I'm just going to trade it in, right? So let's say you trade it in, and you're thinking to yourself, well, my loan balance is higher than what the vehicle is worth, or my trade-in value. Let's say the dealership's going to give you 120,000, and let's say private party's going to give you 125, but you still owe 140,000. So therefore, you're thinking, oh, I'm not going to have a gain. That's not true. That is not true, because let's pretend that you depreciate 100% of the vehicle. Your gain is going to be whatever the trade-in value is, or whatever you sell at a private party minus your cost basis, or whatever your basis is in the vehicle, your adjusted basis. Your adjusted basis is zero because you bought it for 150 and you depreciated 150, right? Or 100. Let's say it's 100 for our math example. So you have a $125,000 gain. Let's break that down and how we got there. You sold it or traded it in for $125,000. Your adjusted basis is a big fat goose egg because you took all the prior depreciation on the tax return. It is not $140,000 of what you owe on the vehicle. The economic value and the economic situation is totally different and removed from the tax situation, right? So you're going to recapture $125,000, and people just don't expect that. No one tells you that on the TikTok videos. And then option three is, let's say you actually go all the way. You pay off your G-Wagon. Let's say you finance it over 5 years, and you pay off the whole G-Wagon. And you think, okay, well, I sold my vehicle, but even though I don't have a loan, I paid down my loan. There's no gain. There's no economic event that happens. It's still wrong. Whatever you sell it for or trade it in for, that is what is going to be registered as, the sales price, again, minus the adjusted basis. You have no basis because you took all of it in depreciation, right? So therefore, that's your gain. So in all three of these scenarios, the depreciation event and the hype and the buzz, they eventually all come back around. You're front loading your deductions essentially, but eventually, it comes due, and that no one wants to talk about that part, and that's why you need to watch this video and understand all of the implications, and don't just say, oh, Chad from TikTok was on there saying that I could write off $150,000. True, part of that might have been true, but there's a lot of stuff that goes into that. So, as always, please consult your tax advisor. This is not as streamlined and straightforward as it seems. So, please always consult your tax advisor on some of these things.